You were taught that supply and demand are zones, boxes on a chart, touched 3 times, confirmed. That belief is quietly destroying your trading, because the truth is brutal. Supply and demand don't get stronger with use, they get used up. And once you understand that, a lot of things that confused you, fake breakouts, stop hunts, sudden reversals, they stop being mysterious. Stay with me. In a few minutes, you'll see why most traders are trading dead levels and calling it strategy. Why your correct trades still fail. You've done everything right. Marked clean zones, waited for confirmation, managed risk, and price still ran straight through your level like it wasn't even there. That's not bad luck. That's a bad model. Today, we're dismantling the retail version of supply and demand, not the textbook one, the real one. By the end, you'll know why price revisits levels before breaking them, stops get hit before moves begin, why prediction skill alone won't save you, and why some markets feel easier than others. Here's the flip. Supply and demand are not lines. They are liquidity conditions. What supply and demand really is. 1. The strong level illusion. Retail logic says, the more times price bounces, the stronger the level. Market logic says the opposite. Every time price returns to a demand zone, something must happen for it to bounce. Buy orders must absorb sell orders. Those buy orders are finite. Think of a sandbag wall holding back water. The first wave hits. Sandbags hold. Second wave. Still holds. Third wave. Some bags tear. You don't get a stronger wall. You get less sand. That's exactly what happens at support. Each test fills buy limits. Each fill removes liquidity from the book. Eventually, there's nothing left to absorb the pressure. That's why levels don't suddenly break. They were empty. Stop and think for a second. If a level keeps holding, why would smart money keep defending it at the same price? They wouldn't. 2. The quiet truth about who moves price. Most traders imagine markets being moved by aggressive orders. Big market buys, big market sells. That's incomplete. The real work happens quietly. Limit orders, passive orders, the ones sitting there before price arrives. Here's the uncomfortable truth. Professional players, especially high-frequency participants, add more information to price through passive orders than aggressive ones. Why does that matter to you? Because supply and demand don't show up when price hits a level. They exist before price gets there. Retail waits for reaction. Professionals position for absorption. That's why your breakout entries feel late, because they are. 3. The stop hunt myth that isn't personal. Let's talk about the most emotional moment in trading. You place a stop just below support. Price dips, stops you out, then rips in your direction. Feels targeted. It's not. It's functional. Large players don't care about your trade. They care about filling size without moving price. And where is guaranteed liquidity? Where retail puts stops. A stop loss is not protection. It's a market order waiting to happen. When it triggers, it becomes instant liquidity. That liquidity allows institutions to exit shorts, enter longs, or flip exposure quietly. So when price dips below a level and snaps back, that wasn't manipulation. That was liquidity conversion. Here's the trap. Retail defines supply and demand by where price bounced. Institutions define it by where orders will be forced to execute. That's the difference. 4. Prediction versus profit. The AI trap. Here's a curveball. Even models that predict price direction extremely well often fail to make money. Why? Because knowing the next tick doesn't equal a tradable edge. Costs exist. Spread, slippage, deposited, timing mismatch. If supply and demand were just about direction, prediction would be enough. But markets are execution games. Liquidity matters more than accuracy. A 90% correct model that trades in thin conditions can lose. A 55% correct trader operating around stable liquidity can win. That should change how you think about setups. 5. Not all markets behave the same. Another myth. All charts are the same. Price is price. No. Market structure matters. Some instruments trade in tight, stable increments. Others are noisy, wide, and chaotic. Markets with tighter spreads and higher resting liquidity behave more predictably. Why? Because order flow is cleaner. Absorption is clearer. Noise is lower. That's why some pairs or stocks respect levels more. It's not magic. It's microstructure. Why this explains your losses. Think back to your worst trades. The level was obvious. Everyone saw it. Price hovered, tapped again. You entered, and then it collapsed. That wasn't the market being irrational. That was liquidity exhaustion. The market didn't break structure. Structure broke first. Price just followed. Here's the weird part. The cleaner the level looks to retail, the more likely it is to be empty. How to trade supply and demand correctly. Let's make this actionable. Use this mental checklist. Before trusting a level, ask 1. Visited this area multiple times? Or, deposited yes, assume liquidity is reduced. 2. Are stops likely clustered just beyond it? Or, does yes expect a probe, not a bounce? 3. Is price approaching fast or slow? O practitioner, more likely to consume remaining orders. Or slow, absorption may still exist. 4. Is the market structurally stable? White spreads, cleaner reactions. Wide spreads, expect noise. If this, then that. For a level keeps holding, prepare for failure. Price sweeps, stops, and reclaims, that's information. A move starts after liquidity is taken, that's real. Trade after liquidity events, not before them. And how to escape them. Trap 1. Buying the third touch. First reaction matters most. Trap 2. Stops at obvious levels. Place stops where your idea is invalid, not visible. Trap 3. Blaming manipulation. Ask what liquidity was needed. Trap 4. Chasing accuracy. Focus on execution context. Trap 5. Treating all markets equally. Trade structures that reward patience. Supply and demand are not zones. They are resources. They don't strengthen, they deplete. Price doesn't move because of lines. It moves because liquidity is found, or gone. Once you stop trading where price was and start thinking about where liquidity still is, your entire perspective changes. Question this next. When price respects a level, is it really respecting it? Or is it just not finished using it yet? Drop it in the comments.